You are standing in the cereal aisle of a grocery store, looking at two boxes of granola. One is labeled $4, the other is $5. You choose the $4 box, feeling a small, quiet spark of satisfaction. You've just optimized your capital. You walk to your car, check your banking app, and see a balance that feels like a temporary holding cell. You tell yourself that this is just the beginning. The goal is the $1,000,000 mark, that clean seven-figure number that represents the border between survival and sovereignty. You believe that by making these small, rational choices, the math will eventually compound in your favor. I'm Arlo. Before we peel back the layers of this particular financial machinery, I'd appreciate it if you'd like the video and subscribe. It helps me keep these investigations going, and I'd value having you along as we look at how these systems actually function. The $1,000,000 dream is marketed as a destination reachable through discipline and smart consumption. You believe that if you work 40 hours a week, save 10%, and avoid the obvious traps, the trajectory is linear. This is the false rationalization of the modern middle class. You view your finances as a series of individual choices, but the institutions managing your life view your finances as a predictable stream of extraction. When you chose the $4 granola, you didn't save a dollar. You simply participated in a price-anchoring ecosystem designed to make the lower price point feel like a victory, ensuring you keep spending rather than questioning the necessity of the purchase itself. The reversal is subtle but mathematically devastating. While you focus on the $1 saved at the grocery store, the structural costs of your life, interest rates, subscription slippage, and the convenience tax are eroding your net worth at a rate of roughly 15 to 22% of your lifetime earnings. This is driven by what behavioral economists call hyperbolic discounting. It is a documented cognitive bias where the human brain overvalues immediate small rewards over much larger delayed ones. Corporations do not fight this bias. They build infrastructure to inhabit it. They know that if they can make a $15 monthly subscription feel invisible, you will pay $1,800 over a decade without a single cognitive protest, even if the service provides zero marginal utility. This is not a series of unfortunate errors. It is a repeatable corporate pattern. Look at the buy now, pay later integration at every digital checkout. It isn't there to help you afford a coat. It is there to decouple the pain of payment from the pleasure of acquisition. By breaking a $400 payment into four $100 installments, firms see a 20 to 30% increase in checkout conversion. The math is simple. When the friction of loss is removed, the volume of extraction increases. The system is designed to keep you in a state of liquid poverty, where you have enough cash to flow through the economy, but never enough to pool into true wealth. Consider the escalating examples of this in your daily life. Your smartphone is no longer a tool you own. It is a gateway to a hardware-as-a-service model. You pay $40 a month for the device, $80 for the data, and perhaps $30 for various cloud and media bundles. That is $150 a month, or $1,800 a year. Over a 40-year working life, assuming a modest 7% market return, that connectivity costs you approximately $380,000 in lost opportunity. That is nearly 40% of your $1,000,000 goal vanished into a single category of utility. When you add the hidden convenience fees on food delivery apps, which often mark up items by 15% before service fees, you are looking at an additional $50,000 to $100,000 over a lifetime. The math of the $1,000,000 dream fails most people because they calculate their wealth based on their income, while the system calculates its wealth based on your leakage. To the bank, you are not a customer seeking a home. You are a 30-year interest-bearing asset. To the platform, you are not a user. You are a data point that can be nudged toward a one-click purchase.
Your identity has been flipped. You are an input in a revenue model, and the model is optimized to ensure that the surplus you generate, the money that would actually make you a millionaire, is harvested before it can ever reach your savings account. To understand why the million-dollar threshold remains a mirage for the majority, we have to look at the lifetime cost of the standard lifestyle path. The system operates on the assumption that you will follow a predictable arc: graduate, finance a car, rent or mortgage a property, and subscribe to a set of recurring digital services. Each of these steps is a point of extraction. A car loan with a 6% interest rate over 72 months doesn't just cost you the sticker price plus interest, it costs you the decade of investment growth that money could have generated. By the time you reach age 45, the interest drag on your life, the sum of all interest paid on depreciating assets, often totals more than $250,000. This is the silent exploitation of the middle-class trap. You're encouraged to feel wealthy by increasing your lifestyle velocity, buying things that look like success, while your actual net worth remains stagnant. Behavioral researchers call this the hedonic treadmill, but corporations recognize it as a perpetual renewal mechanism. They know that the dopamine hit of a new purchase fades within 14 to 30 days. Therefore, the market must provide a constant stream of newness to ensure the extraction never pauses. This is why software updates slow down older hardware, and why fashion cycles have transitioned from 4 seasons to 52 micro-seasons. If we translate these small, habitual losses into a 40-year timeline, the reality is unsettling. The average person loses approximately $1.2 million in potential wealth to 3 specific invisible factors: management fees on retirement accounts, interest on consumer debt, and subscription bloat. A 1% fee on an investment portfolio might sound negligible, but over 40 years, that single percentage point can consume up to 28% of your final balance. You are doing 100% of the work and taking 100% of the risk, but the institution is taking nearly a third of the result simply for providing the ledger. You are not a customer in this scenario. You are an ecosystem participant whose primary role is to maintain the liquidity of the firms you interact with. When a platform offers you a free service, they are not being generous. They are lowering the barrier to entry so they can extract your attention, which is then sold to advertisers who use psychological profiling to trigger your next purchase. It's a closed loop of extraction where your own data is used as a weapon against your future solvency.
The million-dollar dream is the carrot held in front of the engine to keep it running, but the engine is designed to burn that carrot as fuel. Defensive awareness requires a shift in how you perceive every transaction. You must begin to view money not as a medium of exchange for goods, but as a medium of exchange for time. If you earn $30 an hour, a $150 luxury dinner isn't just $150. It is 5 hours of your life that you can never reclaim, plus the 30 hours of future freedom that $150 would have bought if invested. To reduce extraction, you must reintroduce friction where the system has removed it. Use cash for discretionary spending to re-engage the pain of payment. Audit your recurring digital outflows every 90 days with the coldness of a corporate liquidator. Treat your capital with the same predatory focus that corporations use to take it from you. The strategy is not about deprivation, it is about reclaiming the float. The float is the margin of money that usually disappears into the cracks of modern life: the unused gym membership, the premium data plan you don't exhaust, the interest on the credit card you didn't pay off in full this month. In a system designed for maximum extraction, the most radical act you can perform is to become unextractable. This means making your financial life boring, manual, and highly resistant to the psychological nudges of digital interfaces.
The closing truth is that the financial architecture of the 21st century depends entirely on your inattention and your trust. It relies on the fact that you are too tired from working to audit the 0.5% fee or the $9.99 monthly charge. It thrives because you want to believe that the system is built to help you succeed. But the system is not a mentor, it is a vacuum. It is a highly efficient, mathematically precise machine that harvests the quiet moments of your life and converts them into shareholder value. The million-dollar dream isn't impossible. It's just that the path to it requires you to stop being the fuel for everyone else's machine.